Chris Harvey is the head of equity strategy at Wells Fargo Securities. Chris, nice to see you. Where are these traps in your view?
So these traps are everywhere. And when we talk about value traps, it's your early cyclicals. It's companies trading at 2, 3, 4, 5 times earnings, not revenues. And you're finding it in autos, you're finding it in home builders, you're finding it in chemicals, in energy, and in certain financials. So really across the board. This is a place we would stay away from. If you get a pop in these names, these are names that we want to take out of the portfolio.
One of the concerns I've had, Chris, is just in terms of credit in the form of high yield, HYG. That's obviously sort of been trading sideways recently, but that's one thing I'm focused on. Is that a concern that credit's sort of the last to go in this domino effect of the market?
Yeah, credit is a concern. We always watch credit. We watch how it trades. We watch the new issue market. It's wide year to date. The other thing is, if we're right on cyclicals, cyclicals are tied to IG and high yield. If the earnings begin to go down, if there's a derating, you should see that way on credit, and one will really reinforce the other, and that's not a great situation.
Chris, it's Karen. Thanks for being on. So we see in cyclicals, right, they have cyclical multiples as well. Low multiples when things are bad, and actually counterintuitively sometimes higher. How much do you think the E is going in will come down so that the PE isn't really what we think it is and the value isn't really what we think it is?
Okay, Karen, I don't usually talk about stocks, and I don't want to trip myself up, but today I looked at letter X. It is trading at less than 2 times earnings. What the market is saying is those earnings in 3, 6, 12 months are going to be a lot lower. And the multiple that you're really looking at is probably 2, 3, 4, 5 times of what it is. It's late. Again, I can't repeat this enough. It's late in the cycle. These early cyclicals are hard to defend. Earnings are going to be re-rated down. This is a place that we would stay away from. This is a place we want to rotate out of.
Chris, I had to do a double take when I read the notes, and I saw that your S&P 500 target is 47.15, which is quite a ways away from here. Is that accurate, for one? And do we need to we need to see big cap tech pull its weight here? So what sort of earnings setup are we looking at, whether it be this quarter or the guidance going forward?
So a couple things, just on the number, and then I'll get into the question. As far as the number, last year we were bull on the street. We were expecting a melt up. This year we came in with 3rd or 4th lowest on the street. We're expecting a 10% pullback, bear market in a lot of the high flyers. That occurred. We just weren't bearish enough, right? Is that number too high? Maybe, possibly. But what we're saying to clients is we think equities, we didn't think you can make money from the long side at the beginning of the year. We do think you can make money to the long side now. And to your point, it's going to be in the growth names. What we're seeing is indiscriminate selling in a lot of the growth names. A lot of these secular growers are now trading at reasonable prices, anywhere from 14 times to 28 times for secular growers. This is where we want to start to put our money. And this is an environment where growth is going to slow down. The economy will probably go into recession, and growth is going to work. So this, at the margin, is where you want to put your dollar.
When you think about technology, though, the biggest within this big cap tech group is Apple, and that's more of a discretionary stock. So when you talk about a slowdown in the economy and a slowdown in the consumer, doesn't that stock get caught up in that?
Well, how much of your Apple products really discretionary? You probably have a ton of them. And yes, what we're worried about as far as the consumer is we think a consumer recession is coming. What we've been saying is the consumer's balance sheet is really strong, but close to a quarter of it is tied up in the equity markets. When equities are down 20%, that really weighs on sentiment. That really weighs on consumer discretionary spending and ultimately the economy. The catchphrase here is the U.S. economy, the equity beta on the U.S. economy has never been higher. But getting back to Apple, a lot of the Apple products, yes, they're somewhat discretionary, but not as much as you think. And at the end of the day, what we want are companies with stable earnings. We want to gravitate to certainty. We think that's what the market will pay for. And some of those companies are in tech, some of them are in fintech, some are on the consumer side. But what we're seeing again is indiscriminate selling on the growth side. Many of the growth managers I talk to are having a very difficult time. And what we want to do is we want to capitalize upon that.
All right. Chris, good to see you. Thank you. Chris Harvey.
Thank you.
Of Wells Fargo. All right. So on the one side, you have names like an Apple, which could be caught up in a slowdown in consumer spending. You've got a Google and you've got a Meta, whose main source of revenue, ads, they're tracked with GDP. So you see the slowdown in GDP, you see the slowdown in that revenue. But on the other hand, you have very good balance sheets for all of these names.
I don't think balance sheets are concerned at all. I think many of these companies have been able to fortify themselves over the last few years, and they've done the right thing. It's not about that. It's about what does demand cycle look like, right? And in terms of valuations, what do these companies look like? In terms of Apple, real quick, I mean, Katie Huberty at Morgan Stanley, I'm not saying she's saying sell Apple by any stretch, but for the first time in a long time, she's been cautious on the name. And a lot of people out there that think Apple's the last shoe to drop. July 26th, I think they report earnings. I thought the market would rally into Apple earnings, and that would be the next catalyst to take us lower. I'm going to stand by that and think that's going to happen.
Yes.